したくなるでしょう。ほらレビューが始まる。ほら遅れないでね。ほらレビューが始まる。ほら忘れないでね。多分今日は私を見て気がつくはず。あなたもコピーしてるって。私にコピーしてるって。ウォンウォンテレビで見た古い映画ミュージカルのレビューみたいねベイビー。街はいつもパレードベイビー。ほらね聞こえるでしょ。世の中にはハッピーやラッキーがいっぱいあるよね。口づけたい嬉しくて頬ずりしたくなるでしょ。ほらレビューが始まる。ほら遅れないでね。ほらレビューが始まる。ほら忘れないでね。
A new stereophonic sound spectacular.
So, good day, class. So, for today's session, we're now on our week 8. We will be having problems relating to your absorption and variable costing. And we will make our session today more interactive because I will be giving you a time for solving the problems that I will present to you before I can proceed with its proposed solution. Okay? Sige. For our first problem, Lene Company, which has only one product, has provided the following data concerning its most recent month of operation. So it has a selling price of $112, units in beginning inventory that is 500, units produced for the month which is 2,600, units sold of 3,000 units, and units in ending inventory of 100. Its variable cost per unit is $13 for its direct materials, 49 for its direct labor, $6 for its variable manufacturing overhead, $10 for its variable selling and administrative, and of course it has the following fixed cost. So for its fixed manufacturing overhead, it's 80,600. For its fixed selling administrative, it's $15,000. The company produces the same number of units every month, although the sales in units vary from month to month. The company's variable cost per unit and total fixed costs have been constant from month to month. So here are the following requirements. So for letter A, what is the unit product cost for the month under variable costing? Letter B, what is the unit product cost for the month under absorption costing? Letter C, prepare an income statement for the month using the contribution format and the variable costing method. Letter D, prepare an income statement for the month using the absorption costing method. And letter E, reconcile the variable costing and absorption costing net operating incomes for the month. Okay? So guys, I'll be giving you 10 minutes no, for you to solve the problem. And after the 10 minutes, no, I'll be presenting the proposed solution. Okay? Of course, guys, it's only a joke. So, I'll be first solving the problem, no, for you to, get the hang of it, no. Of course, for you also to have an idea on how you can solve this type or kind of problems relating to absorption and variable costing. Okay, so for our first requirement, no, what is the unit product cost for the month under variable costing? Remember that under variable costing, the product cost should only include what? Your direct material, your direct labor, and your variable manufacturing overhead. Okay, is that only the component of the product cost? The answer is what? It's a yes. No, we don't include your variable selling and administrative because again, this is what? A period cost. Okay. So, in letter A, we're looking for the again, the product unit cost. So, what does it include? So, it includes your direct material, your direct labor, and your what? Variable manufacturing overhead. So what's the value of our direct material? It's $13. And then for our direct labor, it's 49. Then for our variable manufacturing overhead, it's $6. So the total is what? It's 13 plus 49 plus 6. It gives us $68. Okay? For letter B, what if we are looking for the unit product cost under absorption costing? So, if that is the case, so it's just the same with the variable costing. We are now adding the what? Fixed manufacturing overhead. Okay? So, I need again to write your component. No, we have your direct material, direct labor, and variable manufacturing overhead, and we now need to compute for our fixed manufacturing overhead. However, the amount here, it's in total, no, and we need to get the per unit. So how do we do that? It's what? 80,600 total divided by the units produced of 2,600. Okay, and that will give us a value of 8,600 divided by 2,600, it's $31. Okay? So we just put the figures here, 13 for the direct material, $49 for our direct labor, and variable manufacturing overhead is it's $6. So the total would be, so it's 68 plus 31, it is in $99. Okay? So for our next requirement, prepare an income statement for the month using the contribution format and the variable costing method. So I need to erase this one. Okay? So let's remember your product cost or unit product cost for variable costing, it's 68. Okay? For variable costing, it's $68 per unit. And for our absorption costing, it's uh, sorry, that's 60. Okay, in here, it should be $99 per unit. Okay, can now erase this one. Okay, first we need to prepare for the contribution margin format. Contribution margin format. So remember, in our contribution margin format, it's gonna be your sales less your variable cost. This equal to contribution margin. Then we deduct our fixed cost, and we get now your operating income. Okay. So let's start with sales. So what is your sales here? It's what? Your units sold of 3,000 units multiply by the selling price of $112. It will give us a value of $336,000. Okay? We need to get the total variable cost, no, that is related to the units that we produce and sell. So in here we have your raw materials beginning. So how do we compute for our raw materials beginning? It's the units in beginning inventory 500. Then we multiply it by the unit product cost under variable costing of $68. And that will give us a value of $34,000. Okay. Then now we add our variable manufacturing cost. So how do we compute the variable manufacturing cost? It's the units that we produced in here. Okay. It's 2,600. Then multiply by the unit product cost under variable costing of $68. And that will give us a value of 176,800. Then, what do we call the total for this one? 34,000 plus 176,800. It will give us a total value of 210,800. Okay? This is what we call your cost of goods available for sale. Okay, and now we deduct our raw material ending. And how do we get your raw material ending? In here we have units in ending inventory of 100, right? And then we multiply it by our unit product cost of $68. And that will give us a value of 6,800. Okay? Okay. And when we deduct the raw material ending from the cost of goods available for sale, we call it your variable cost of goods sold. Okay? Its value now, it's 204,000. Are we done? Not yet. We need to get variable what? selling and administrative expenses. Now, how do we get that? Okay, in here we have $10. Okay, so what is the multiplier here? It will be your units sold of 3,000 units. Okay, so the value here is it's 3,000 times 10, it's 30,000. Okay, and when we add your variable cost of goods sold and variable selling and administrative expense, it will give us a variable cost of $234,000. Okay? Then, we deduct this amount from the sales to give us your contribution margin of okay, it's 336,000 minus 234,000. It's 102,000. So we have your contribution margin of 102,000. Are we done? Not yet. We need to deduct your fixed cost. Okay? Okay. For our fixed cost, now we have two. Okay? Okay, we have one, your fixed manufacturing overhead, and we have your fixed selling and administrative expenses. Okay? So for our fixed manufacturing overhead, please do remember, in variable costing, regardless of the production or sales, the full amount relating to the fixed manufacturing overhead will be treated as what? As period cost. So it does not it will not be affected by the units sold or produced. So meaning to say, the whole amount here that we have incurred for the period, okay, it will be outrightly expense, okay, as period cost. Okay, and for the fixed selling and administrative expense, no, this relates to the selling activity, no. So this amount is by itself, it's a fully deductible expense. Okay, so it's 15,000. Okay, your total fixed cost will be, now we add the two, it's 95,600. Okay, and then we deduct the fixed cost from the contribution margin, we have your operating income of, okay, 6,400. Okay, so our net income under absorption costing, $6,400. Okay? Okay, I'll erase this portion, no? The net operating income for variable costing, it's what? 6,400. We are looking for the now income statement pertaining to the absorption costing method. So with absorption costing method, same with variable costing, we will start with what? Your sales. So your sales, okay? You have already got this one, right? So it's a unit sold of 3,000 multiplied by the unit selling price of $112. It will give us a value of $336,000. Okay? For our cost of goods sold, no, in here, no, we only need to um, use the value of the unit product cost under absorption costing of 99. So we don't need anymore to dissect the cost of goods sold into variable and fixed cost, no, pertain to the cost of goods sold, because it is now already incorporated in this unit product cost. Okay, so for our cost of goods sold, okay, we'll be starting with your beginning inventory. Your beginning inventory here is computed as 500 units multiplied by the unit product cost of 99, and it will give us a value of 49,500. Okay, and then we now compute for your cost of goods manufactured. So how do we compute for cost of goods manufactured? It's the units produced multiply by the unit product cost under absorption costing again of $99. So it's 2,600 times 99. It will give us a value of 257,400. Okay? Then when we add the two, it is what we call your TGAS or total cost of goods available for sale. Okay? So its total is 306,900. So for our ending inventory, no, we have here your units in ending inventory of 100, and we multiply it by the uh, again your units your unit product cost of 99. It's 9,900. Okay, and it will give us a value of 297,000. Okay, what do you notice in here? So in the absorption costing, no, your fixed manufacturing overhead is part of your cost of goods sold. Okay, whereas with variable costing, it is treated as period cost. So it's separate from the cost of goods sold. No, kumbaga, it will not be part of your variable cost. Okay, it will form part of the fixed cost. Okay, with the absorption costing again, your fixed manufacturing overhead is included in your cost of goods sold. So, okay, so when we deduct here now your cost of goods sold from sales, it will give us, okay, a gross margin or gross profit of, okay, $39,000. Okay. Okay, for our selling and administrative expenses, so we have two, right? So we have your variable and we have your fixed. Okay, for your variable, no, we will just look, no, remember that in selling and administrative expense, it is driven by the units sold, okay, not by the units produced. So for your variable, it's 3,000 units multiplied by our variable selling and administrative cost per unit of $10. That will give us $30,000. Okay. For our fixed, no, it is already given here. It's 15,000. So we'll just write it in here. So your total selling and administrative expense is how much? It's $45,000. Okay? And when we deduct, okay, the amount of $45,000 being your selling and administrative expense from your gross margin, it will give us an operating income of, this is negative. Okay? So if this is negative, is it operating income? No, it is operating loss. Okay? So I'll just put it in here. It's $6,000 loss. Okay? So I'll just erase this one. Okay? Okay, the next requirement, or the last requirement, is to reconcile the variable costing and absorption costing net operating incomes for this month. Okay? So let's start with the net operating income under variable costing. So that is how much? 6,400. So how do we now analyze this kind of problem? Okay, so please do remember the rule, no? We have two kinds, no? So if your units sold is higher than your units produced,
then what will happen to the net operating income under variable and absorption costing? No, in this case, you have a higher income for variable costing as compared to your absorption costing. Why? Please do remember that the fixed manufacturing overhead, no, coming from the inventory, from the beginning inventory and the units produced, no, for the month is now fully expense for the current period. Okay? That makes the absorption costing having a lesser net operating income as compared to your variable costing. Okay, in variable costing, please do remember that the inventory pertaining in the beginning inventory, no, they were outrightly expensed for the previous period. Okay, so it doesn't have any effect anymore on the current period. Whereas with absorption costing, the fixed manufacturing overhead that is part of the inventoriable cost in the beginning inventory is now fully expensed. Okay, making it having a lower income. Okay? Or what will happen if your units produced is higher than your units sold? Okay, it will now be a different case. Okay, so your variable costing has now less income as compared to your absorption costing. Okay, why? Because again, your fixed manufacturing overhead cost that you incurred for the current period, no, it will be fully expensed as period cost. Okay, whereas with absorption costing, no, you still have an inventory, no, a good number of because you still have a number of inventory, no, because you have more units produced than sold, no, the fixed manufacturing overhead cost that is component of the product cost in the inventoriable or that is part of the inventory, no, it is not expense outright as compared to your variable costing. Okay, so let's solve this reconciliation. So we have here your net operating income variable costing 6,400. So what do we do now? We deduct your what? Fixed manufacturing overhead. Okay? The fixed manufacturing overhead cost released from inventory under absorption costing. So how do we compute for that? Okay? It is the difference of the units produced and sold by how much? It's 3,000 units minus 2,600. Okay, and then we multiply your fixed manufacturing overhead, no, cost or unit cost of 80,600 divided by the units produced of 2,600. I think we have already computed this one. It is what? Okay, that is what? It's $31. So it will give us a value of 400 times 31. It is 12,400. And when we deduct the value, no, we should get the net operating income under absorption costing of 6,000. No? In this case, it is negative. It is a net operating loss. Okay. Na-reconcile natin. Tama ba? Yes. Ito siya. So, 6,400 for the net operating income under absorption costing. Net operating income under variable costing. 6,400 here, 6,400 here. And then your net operating income for absorption costing is 6,000 here, or negative 6,000, or net operating loss of 6,000. Then same here of negative 6,000 or 6,000 operating loss. Okay? Okay, for our second problem, the Dean Company produces and sells a single product. The following data refer to the year just completed. The beginning inventory is 0. Your units produced is 20,000. Your units sold is 19,000. Your selling price per unit is $350. Your selling and administrative expenses is composed of your variable per unit of $10. Your fixed, in terms of total, it's $225,000. And you have the following manufacturing costs pertaining to your direct material cost per unit of $190, direct labor cost per unit of $40, variable manufacturing overhead cost per unit of $25, and fixed manufacturing overhead in terms of total $250,000. Assume that direct labor is a variable cost. So what are the requirements for letter A? Compute the cost of a single unit of product under both the absorption costing and variable costing approaches. Second, prepare an income statement for the year using absorption costing. Third, no, or letter C, prepare an income statement for the year using variable costing. Letter D, reconcile the absorption costing and variable costing net operating income figures in B and C above. So guys, I'll give you 15 to 20 minutes for you to answer before I can show you the proposed solution for this problem. So you need really to compute this one so you can assess well if you are in a way keeping up with concepts. No, if not, no, don't worry. We'll be having another set of problems later on. Okay, so please do solve this problem for again 15 to 20 minutes. Okay. So, guys, time's up. So, first, we need to solve letter A. So, for letter A, we are looking for the single unit of product cost or the unit cost of the product. No? First, we need to compute for the absorption costing. Okay? So, under absorption costing, remember, no, we include all the costs related to the product cost. Let's say, for example, your direct material, your direct labor, your variable overhead, and manufacturing overhead cost. In this case, what is our direct material cost per unit? It's $190. Okay, for our direct labor cost per unit, it's 40. For our variable overhead cost, it's $25. So how about for the manufacturing this is fixed, okay? Fixed overhead. So for our fixed overhead, it's what? How do we compute for that one? No, it's your total fixed overhead cost of $250,000 divided by the units produced of 20,000. Okay? And it will give us a value of 12.50. So your total unit product cost under absorption costing, it's 190 plus 40 plus 25 plus 12.5. Okay? It should give us a value of $267.50. Okay. This is your product cost per unit under absorption costing. Okay, how about for the variable costing? So it will only include these three items, no? Your direct material, your direct labor, and your variable overhead. So it's 190, then 40, and 25. That should give us a value of $255 per unit. That is what? Your product cost under variable costing. Okay? So I'll just delete this one, okay? Okay, then I'll write here, okay, in letter A, so your product cost per unit under absorption costing, it's 267.5. While for your variable costing, it's $255. So for letter B, we need to prepare the income statement under absorption costing. So, okay. As a start, we need to compute your sales. So, how do we compute for the sales? It's the units sold of 19,000 units multiplied by the selling price per unit of $350. That should give us a value of $6,650,000. Okay, and then now we need to compute your cost of goods sold. Okay, so for your beginning inventory, how do we compute for your beginning inventory? It's the, do you have any beginning inventory? None, so 0. Then we multiply by the product cost per unit under absorption costing of 267.5, and it will give us a value of 0. Okay, and then for your cost of goods manufactured, it's your cost of goods completed or cost of completed goods. It's the units produced of 20,000 multiplied by your product cost per unit of $267.50. So it shall give us a value of $5,350,000. Okay? And then when we add the two, it will give us a value of total cost of goods available for sale, same with the amount of COGM of $5,350,000. And then we deduct your ending inventory. So how do we compute for the ending inventory? How many is the units that is remaining on hand? Okay, so please do remember that we have a units produced of 20,000. Okay, and then we have units sold of 19,000. So it remains that there is still a 1,000 units as your ending inventory, given that you don't have any beginning inventory. If you have a beginning inventory, you need to add your beginning inventory, then you add your units produced, you deduct your units sold, it will give you the ending inventory, no, in terms of quantity. And then we multiply it by the product cost per unit of 267.5. And it will give us a value of 267,500. Okay? It shall give us a value of 5,082,500. So that is our cost of goods sold. Okay? And when we deduct your cost of goods sold from your sales, it will give us a gross margin or profit amounting to 1,567,500. Okay. And then we need to deduct now your selling and administrative expenses. That is broken down into two. So we have your your variable and your fixed. For your variable, how do we compute for your variable cost? No, pertain to selling and administrative expenses. So we have here your variable per unit pertain to your selling and administrative expense of $10. So what do we use? Is it units produced or units sold? Of course, we will use the units sold. The units produced doesn't have any it will not be considered because it pertains to the manufacturing operations. Well, for the units sold, definitely it will have a effect on the selling and administrative expense. So hence we will use your 19,000 quantity that is or that was sold. Okay, so the total here it's $190,000, and then we add your fixed cost. Your fixed cost here, okay, in total it's $225,000. Okay, and then we will have a total value of your selling and administrative expense of $415. Okay, and when we deduct your selling and administrative expense from your gross margin or profit, it will give us your operating income. No, this operating income is under your absorption costing. Okay, so it will give us a value of 1,152,500. So this amount, no, it's your operating income under absorption costing. Okay, okay, just let me erase this income statement, and we'll now prepare the income statement under variable costing, no, the letter C. Okay, okay, under C. Okay, we'll start with your sales. Okay, so your sales, we have already computed this one. Okay, again, it's your unit sold of 19,000 multiplied by your selling price per unit of $350, and it will give us a value of $6,650,000. Okay, and then no, instead of deducting your cost of goods sold, no, since we are doing income statement under variable costing, we will deduct your variable cost. Your variable cost here is composed of two. We have your cost of goods sold and your selling and administrative expense. Okay, So, for your cost of goods sold, we'll start with your beginning inventory. Okay, do you have any beginning inventory? We don't have, so it will be 0. Okay, do you have any cost of goods manufactured? Yes, we do have, no? The units produced, that is 20,000. Then, we now multiply it, no, using the product cost per unit under variable costing of $255. Okay, so that will give us a value of 5,100,000. Okay? Since we don't have any value for your beginning inventory, your cost of goods sold will now be your total cost of goods available for sale, okay, amounting also to 5,100,000. And then we will deduct your ending inventory, okay, of in this case, no, again, we have discussed earlier that you have a remaining of 1,000 units on hand. So it's 1,000 units or quantity multiplied by your product cost per unit under variable costing of $255. So it should give you a value of 255,000. Okay, so your ending inventory will be deducted from your TIGAS in order to give us your what? Variable cost of goods sold. Okay? It will give us a value of $4,845,000. Okay, we now need to add your selling and administrative expenses. That is variable also. Okay, so how do you compute for that one? So in terms of quantity, what do we need to use? Is it units sold or units produced? Since this is your selling and administrative expense is a period cost, it will not the quantity that we will use is pertaining to your units sold, not units produced. Okay, since this is again selling and administrative, it will be drive by the units sold, no, not unit produced. Okay, so we have here, no, 19,000 multiplied by the unit product cost. Is it correct? No, we will use your variable per unit that pertains to your selling and administrative expense of 10. Okay? So, it shall give us a value of 190,000. So, since we have now both the values of your variable cost of goods sold and variable selling and administrative expense, it will give us a total variable cost of 5,035,000. Okay, and we will deduct this value, no, this variable cost from your sales, no, in order to compute for our contribution margin. Okay, your contribution margin, no, it amounted to how much? 1,615,000. Okay? Are we done? Not yet. We need to deduct now your fixed cost. Your fixed cost is composed also of two. Okay? No? We need to add your fixed manufacturing overhead. So how do we compute for your fixed manufacturing overhead? Okay, it's the what? Units produced. Okay, it's 20,000 multiplied by the fixed overhead cost per unit of 1250. Okay, we have already computed this one earlier. You can also skip this computation, but rather if the total value is given here, you can just put it here, the total value of $250,000. Okay, so when you compute this one, no, it still be the same. Please do remember that under variable costing, your fixed manufacturing overhead cost is not affected by the units produced. Okay, so it's still $250,000. And for your fixed selling and administrative expense, it is already given here. Okay, it's $225,000. And then we add the two, it will give us your fixed cost of $475,000. So we will deduct $475,000 as your fixed cost from your contribution margin, no, in order to give us your operating income under variable costing. Okay, so that is 1,140,000. Okay. Okay, I just need to put here our answers. Okay, for letter B, no, our operating income under absorption costing, it's 1,152,500. Okay, for letter C, your operating income under variable costing, it's what? $1,140,000. Okay, so I'll just erase this one. Okay. Okay, for our last requirement in this problem, no, reconcile the absorption costing and variable costing in net operating income figures in B and C above. Okay, again, I need to highlight again, no, if in this case, no, the units produced is higher than your units sold, okay, the related fixed manufacturing overhead that is part of your product cost under absorption costing will be now included in your ending inventory. So meaning it will stay in that account. Okay. Whereas with variable costing, your incurrence or the fixed manufacturing overhead cost that you incurred is fully recognized in your income statement as expense. It will not be an inventoriable cost. So in this case, since the fixed manufacturing overhead cost, no, under variable costing is now outrightly expense, our expectation is that the resulting operating income or net income will be less than the operating income under absorption costing, just like in this problem. Okay. What's the reason behind? Again, it is because of the fixed manufacturing overhead cost. Under absorption costing, a portion of that cost will be included in your inventory, hence not yet accounted as an expense item. And that 1,000 units, no, the one that we have earlier, no, it will be only expense when the units are sold. Okay, in this case, no, since that 1,000 units, no, under variable costing, no, it is not an inventoriable cost or will not be form part of the inventory cost. That is why that full amount will be expense or fully recognized an expense item. Okay, that is why you have a lower net income under variable costing. Okay, in letter D, we need to have a reconciliation, okay, between absorption and variable costing net operating income. Okay, we'll start with our net operating income under variable costing. Okay, that is what? 1,140,000. And we also note that earlier, no, the difference usually in the net income under both methods relates to or pertains to the fixed manufacturing overhead cost. In this case, no, the fixed manufacturing overhead cost that is expense outright here in variable costing should be what? Added back. Okay, so we need to add the fixed manufacturing overhead cost deferred in inventory under absorption costing. So how do we compute for that? Okay, it's the 1,000 units remaining multiplied by the fixed manufacturing overhead cost per unit of 1250. Okay. And when we multiply this both, it will give us a value of 12,500. Okay, it should be added back. Okay. Okay, the resulting value here, no, when we add both, it should be what your net operating income under absorption costing. Okay. So how much is that? It's 1,152,500. Okay. Amazing, right? So we have your net operating income under variable costing of $1,140,000. So it's in here, and the reconciled amount, no, pertaining to our net operating income under absorption costing, it's also here. Okay. So class, what if, no, the units produced and the units sold during the period is the same? So would there be any difference in the net operating income under both methods? The answer is no. No, there will be no differences. Okay? So there will be no reconciliation. Okay, your operating income under absorption costing and operating income under variable costing should be the same. Okay, under methods. Okay? If both the units produced and sold are equal. Okay? So guys, let's have a 10-minute break, and after that we'll have more problems about variable and absorption costing. Okay?
Go on, leave me breathless. Come on. The daylight's fading slowly, but time with you is standing still. I'm waiting for you only. to fine and dandy, yeah. And it really doesn't matter that we don't eat. And it really doesn't matter if we never sleep. No, it really doesn't matter. Really doesn't matter at all. 'Cause we are so young now. We are so young now. And when tomorrow comes, we can do it all again. We are chasing the mood, just running wild and free. We are following through every dream and every need. And it really doesn't matter if we don't eat. And it really doesn't matter if we never sleep. No, it really doesn't matter. Really doesn't matter at all. 'Cause we are so young now. We are so young now. And when tomorrow comes, we can do it all again. Yeah, we are so young now. We are so young now. And when tomorrow comes, we'll just do it all again. All again. All again. Yeah. All again. All again. Yeah, yeah, yeah. So young now. We are so young now. And when tomorrow comes, we'll just do it all again. Yeah, we are so young now. We are so young now. And when tomorrow comes, we'll just do it all again. We are so young, yeah. We are so young, yeah. We are so
Okay, guys. So now we will be having a multiple choice problem. So I'll be reading the problem for you, and then I'll be giving you 5 to 10 minutes to answer the problem before I can show you the answer and solve the problems. Okay? For our first multiple choice problem, Shun Corporation manufactures and sells a handheld calculator. The following information relates to Shun's operation for last year. So we have here your unit product cost under variable costing amounted to $5.20 per unit. While for your fixed manufacturing overhead cost for the year, it's $260,000. For your fixed selling and administrative cost for the year, it amounted to $180,000. And the units calculators produced and sold, no, it's 400,000 units. The question here is, what is Shun's unit product cost under absorption costing for last year? Is it letter A, $4.10? Is it letter B, $4.55? Is it letter C, $5.85? Or is it letter D, $6.30? So I'll be giving you 5 minutes, no, to solve this problem. Okay? So guys, what is our answer for this problem? It's letter C. So how did we compute for that? Okay, we are asking for the unit product cost under absorption costing. Please do remember that we have here your units product cost under variable costing. Remember that under variable costing, your unit product cost consists of what? It's your direct material, direct labor, and variable manufacturing overhead. So, there is a missing item in that unit product cost elements under variable costing to make it a unit product cost under absorption costing. So what is it, that element? It is your fixed manufacturing overhead cost. Okay? So what do we do with that? Okay? We have here your fixed manufacturing overhead cost of $260,000. We only divide it by the units produced. Okay? In this case, no, your produced and sold is the same. So we will divide $260,000 by $400,000 to get your fixed manufacturing cost per unit that is to be added to our unit product cost under variable costing. And then we add the two, no, it will give us the correct unit product cost under absorption costing. So I'll provide here the solution. So we have here your unit product cost, okay, under variable costing. And then we add your fixed manufacturing overhead cost per unit. And how do we do that? It's what? $260,000 divided by the units produced of $400,000. Okay, we have here your unit product cost of variable costing of $5.20. For $260,000 divided by $400,000, it shall give us a value of 0.65, right? And then we add the 2, okay? The $5.85, it is what? Your unit product cost under what? Absorption costing. Okay, the answer again, it's letter C. Okay, next problem. A manufacturing company that produces a single product has provided the following data concerning its most recent month of operation. So we have here your selling price of $79, your units in beginning inventory of 0, your units produced of 6,600, your units sold of 6,300, and your units in ending inventory of 300. And we have here your variable cost per unit of under direct materials of $14, direct labor of $30, your variable manufacturing overhead of $4, your variable selling and administrative of $8, and your fixed cost comprising of 2. We have your fixed manufacturing overhead amounting to $46,200, your fixed selling and administrative expenses of $88,200. And the question here is that what is the total period cost for the month under variable costing approach? Is it letter A, 138,600? Is it letter B, 134,400? Is it letter C, 46,200? Or is it letter D, 184,800? Okay, so I'll be giving you 10 minutes for this problem. Okay. So guys, what is our answer in this problem? It's letter D. So how did we get that amount? Okay. So why? Why is it 184,800? Remember guys, under variable costing approach, okay, your period costs such as what? Your fixed selling and administrative expense, your variable selling and administrative expense would be what? No? It is still, or these are still your period costs. Is it only the two is included in the period cost? The answer is no. We are missing another one item. What is that? It is what? Your fixed manufacturing overhead. Remember, under variable costing, your fixed manufacturing overhead is treated as your period cost. Okay? So, we will be having three items, no? In computing the period cost under variable costing approach. So, the solution here is that we need to add your variable selling and administrative expenses. So how do we compute for that? It is your variable cost per unit relating to selling and administrative expense of $8 multiplied by the units what produced or sold. It is your unit sold of 6,300, right? Okay, and then that should give us a value of $50,400. Okay, and then we need to add your fixed selling and administrative expense that is already given here. Okay? It is what? 88,200. Right? Okay? And then we need to add your what? Fixed manufacturing overhead that is already given here. Okay? It is how much? 46,200. Okay? And then, when we add the 3, it should give us a value of 184,800. So, this is what? Your period cost under variable costing. Okay? What if the question is, what is the period cost under absorption costing? So, that is the case. We just need to, what? Exclude the fixed manufacturing overhead cost. Okay? Okay? Under absorption costing. So the value of our period cost under absorption costing should only include all the expenses related to selling and administrative expenses. And again, your fixed manufacturing overhead under absorption costing will be part of your product cost. Okay, but in this case, the fixed manufacturing overhead cost under variable costing will be included as part of your period cost. So the answer here is again letter D. Okay? Okay, next problem. Manufacturing company that produces a single product has provided the following data concerning its most recent month of operation. So we have here your units in beginning inventory of 0, units produced of 7,100, your units sold of 7,000, and of course your units in ending inventory of 100. And then we have your variable cost per unit of $33 for your direct materials, $53 for your direct labor, $1 for your variable manufacturing overhead, $7 for your variable selling and administrative expenses, and we have here your fixed cost relating to your manufacturing overhead amounting to 170,400, your fixed selling and administrative expense of 7,000. So the question here is, what is the unit product cost for the month under variable costing? Is it letter A, $118? Is it letter B, $94? Is it letter C, $111? Is it letter D, $87? So I'll be giving you another 5 minutes, no? So it will be shorter because you're already familiar with this kind of structure, okay? Okay, guys, what is the answer in this problem? It is letter D. So how did we get letter D? $87. Okay, it's very simple, no? We are only getting the unit product cost under variable costing. Remember that in the unit product cost under variable costing, we only account three elements, no? We have your direct material, your direct labor, and your variable manufacturing overhead. And your fixed manufacturing overhead will be what? Treated as part of your period cost, and it will not be part of the unit product cost. So it's very easy. You need only to add these three items. Okay? And it should give you a total value of $87 per unit. Okay? So the answer is letter D. Okay? Okay, next problem. A manufacturing company that produces a single product has provided the following data concerning its most recent month of operation. So we have here your selling price of $97, your units in beginning inventory of 0, your units produced of 2,200, your units sold of 2,100, and your units in ending inventory of 100. And then we have here your variable cost per unit of $32 direct material, $25 for direct labor, $2 for your variable manufacturing overhead, and $9 for your variable selling and administrative expenses. And we also have incurred the following fixed cost. For your fixed manufacturing overhead, it's 8,800. For your fixed selling and administrative expense, it is 37,800. So the question here, what is the total period cost for the month under absorption costing approach? So we have here letter A, is it 56,700? Is it letter B, 65,500? Is it letter C, 8,800? Or is it letter D, 37,800? So I'll be giving you, okay, 10 minutes for this one. Okay. So what is your answer in this problem? It is letter what? A. Okay, how did we get that? Okay. First, under absorption costing, remember this is our traditional costing, right? So the period cost will be only what? Your selling and administrative expenses. Okay. So in this case, no, it is only what? Your selling and administrative expenses. So this is composed of two. No, we have your fixed and we have your variable. Okay, in here we have already your fixed, no, amounting to 37,800, right? How do we get the variable cost? It is what? Your variable cost per unit relating to your variable selling and administrative of $9 and multiply it by the units what? Produced or sold. It is what? Units sold of 2,100 and it should give us a value of 18,900. And when we add the two, it shall give us a total period cost of what? 56,700 under absorption costing. Okay, so this is again your period cost under absorption costing. So the answer is letter A. Okay? Okay, next problem. The following data pertain to last year's operation at Clarkson Incorporated, a company that produces a single product. So we have here your units in beginning inventory of 0, your units produced of $100,000, your units sold of $98,000. So the remaining inventory here is what? It's 2,000. Okay, your selling price per unit is $10. Your variable cost per unit relating to the direct material, it's $1.50 or centavos. And then your direct labor amounting to $2.50. For your variable manufacturing overhead, it's $1. And then for your variable selling and administrative expense, it's $2 per unit. Then we have incurred the following fixed costs for the year. No, your fixed manufacturing overhead, it's $200,000. Your fixed selling and administrative expense is $50,000. Question here is, what was the absorption costing net operating income last year? Is it letter A, 44,000? Is it letter B, 48,000? Is it letter C, 50,000? Or is it letter D, $49,000? So I'll be giving you another 10 minutes to solve this problem. Okay? What is the requirement again? It is your net operating income for absorption costing for last year. Okay? So guys, please compute. So, what is our answer in this problem? It is letter B, 48,000. Okay. Okay, in order to compute the net operating income, we'll start with what? Your sales. Okay, what is our sales in this problem? Okay, it's your units sold of 98,000 units multiplied by your selling price per unit of $10. Okay, that will give us a value of what? $980,000. For our cost of goods sold, so do we have any beginning inventory? So since it's 0, so we put here 0, right? And then we have your cost of goods manufactured or cost of completed goods of, how do we compute for that? It's your units produced of 100,000 multiplied by the product cost under what? Absorption costing. So how do we get that? No, we need to get that also. So we have here your direct material, direct labor, your variable overhead, and your manufacturing overhead. So we have here your direct material cost of $1.50. For your direct labor, it's $2.50. For your variable overhead, no, we have here your $1. And for your manufacturing overhead cost, how do we compute that one? It is $200,000 by what? Units, what? Produce of $100. Okay? And it will give us a value of $2. So when we add these three, it should give us your product cost per unit under absorption costing of $7. Okay? So it's 100,000 units produced multiplied by the product cost under absorption costing of 7, it will give us a value of $700,000 as your cost of goods manufactured. So your TGAS or your total goods available for sale, it's still at $700,000 since we don't have any beginning balance pertaining to inventory. Okay? And then now we deduct your ending inventory. Your ending inventory here is what? It's your, do you have any value here of any inventory? We don't have, but we can compute it, right? So in here, we have your units produced and units sold. So there's a remaining of 2,000 inventory on hand as your ending inventory. So that is 2,000 multiplied by the what? Product cost under absorption costing of 7. And it shall give you a value of 14,000. So we deduct your ending inventory here. So in this case, we can now compute for our cost of goods sold. So how much is our cost of goods sold? It's $686,000. Okay? And then we shall deduct your cost of goods sold from your sales in order for us to get your gross margin or profit amounting to $294,000. Are we done? Not yet. We need to compute the selling and administrative expenses. Okay, your selling and administrative expense, we have two. We have your variable and we have your fixed, right? So how do we get your variable? Your variable here, now we have $2 per unit, and then we multiply it by the units what? Produced or sold. It is sold. So it's 98,000. So we have here a total of 196,000 as your variable selling and administrative expense. How about for the fixed? So it's already given in this case. So it's 50,000. So when we add the two, we will now get your total selling and administrative expense of 246,000. And when we deduct your selling and administrative expense of 246,000 to your gross margin, it will give us your operating income under Absorption costing of what? 48,000. Okay? So the answer here is letter B. Okay? Okay, next problem. A manufacturing company that produces a single product has provided the following data concerning its most recent month of operation. So we have here selling price of $135, your units in beginning inventory of 0, your units produced of 6,400, your units sold of 6,200, and your units in ending inventory of 200. And we have here your variable cost per unit relating to your direct materials amounting to $49, direct labor of $38, your variable manufacturing overhead of $6, and your variable selling and administrative expense of $11. And the company had incurred the following fixed cost, no? So for your fixed manufacturing overhead, it's 108,800, and for your fixed selling and administrative, it's 74,400. So the question here is, what is the total contribution margin for the month under variable costing approach? Is it letter A, $155,000? Is it letter B, $260,400? Is it letter C, $192,200? Or is it letter D, $83,400? Again, I'll be giving you another 10 minutes, no, to solve this problem. So guys, what is the answer? It's letter C. So how did we compute for that? First, no, we need to get your product cost unit or unit product cost under variable costing. Okay, so in this case, we need only to add this three, right? It's $49 for your direct material. For your direct labor, it's $38. For your variable manufacturing overhead, it's $6. It will give us a product cost of $93 per unit. Okay, so since we are looking for the contribution margin under variable costing approach, no, how do we compute for that? So we have here your sales, right? Our sales is what? Units sold of 6,200 multiply by the selling price of $135. Then it shall give us a value of $837,000. Okay? And we need to deduct your variable cost. Your variable cost, so we have here your cost of goods sold. Okay? So, do you have any beginning inventory in this case? So, we don't have. So, it's 0. Okay? How about cost of goods manufactured? No, we have. So, it is what? Your units produced of 6,400 multiply by the product cost under variable costing of $93. And it shall give us a value of 6,400 times 93. It's 595,200. Okay? And when we add these two, it shall give us your total goods available for sale also of 595,200. Do you have any ending inventory? Yes, we have an ending inventory of how much? It's given here. It's 200. So how do we compute for that one? It's 200 multiplied by the product cost under variable costing of 93. So it's 200 times 93. It's 18,600. Then we deduct this amount from the TGAS. It shall give us a value of your variable cost of goods sold amounting to $576,600. Are we done? We only get the cost of goods sold. How about for your variable selling and administrative expense? How do we compute for that? No? So we have here your units produced of 6,000. Is it unit produced or sold? It is sold. So it should be 6,200 relating only to the units sold, no, not to the units produced. So it's 6,200 multiplied by the variable cost per unit relating to the variable selling and administrative expense of 11. Okay? So it's 6,200 times 11. It shall give us a value of 68,200. Okay? And then when we add the 2, it shall give us your total variable cost of 644,800. So we now have your variable cost, and now we deduct your variable cost from your sales in order to get the contribution margin. That is the requirement of the problem. So your contribution margin here, it's 837,000 minus 644,800. It shall give us a value of 192,200. Okay? So the answer is what? Letter C. Okay? Next problem. Swifton Company produces a single product. Last year, the company had net operating income of $40,000 using variable costing. Big ending inventories were 22,000 and 27,000 units respectively. If the fixed manufacturing overhead cost was $3 per unit, what was the income using absorption costing? Okay, guys, I'll give you another 10 minutes to solve this problem. Okay? So guys, what is our answer here? It's letter D, $55,000. So how did we compute for this one? Treatment in the problem would be reconciliation. Okay, so so we have here beginning and ending inventory of 22,000 and 27,000 units respectively. So what can we infer in this sentence? Meaning to say, the ending inventory had an increase of 5,000. Meaning to say, we produce what? More than what we sold. That is why there is an increase in our inventory of 5,000 units. If that is the case, if we have produced more, so what will happen? Again, if we have produced more than what we have sold, the net income or the operating income under variable costing is less than the net operating income under absorption costing. Why? Because again, no, the units produced there, no, the manufacturing overhead cost in that scenario is what? Outrightly expense in the income statement. That is why we have a lower variable costing. Whereas with absorption costing, your manufacturing overhead cost is in the inventory. Meaning to say, we only deduct a lower cost of goods sold, making the operating income under absorption costing higher than the variable costing. So if that is the case, no, we can solve this one. Okay. Again, no, the answer here is letter D, right? Okay, so we have here your net operating income under variable costing of $40,000. And we all know that if you produce more than you sold, the net income under variable costing is lower or less than the net operating income under absorption costing. So in here, we need to add what? Your fixed manufacturing overhead cost deferred in inventory under absorption costing. And how can we compute for that one? So it's the difference in the inventory of 5,000 units. So how did we get that? Again, it's your difference of your beginning and ending inventory of 5,000 multiply again by your fixed manufacturing overhead cost per unit of $3. So that is 3. And the product here, it's 15,000. So we add now the fixed manufacturing overhead that was deferred in inventory under absorption costing in the variable costing in order for us to compute for the net operating income under absorption costing. So it's what? $55,000. Okay? So the answer here is letter D. Okay? Next problem. Blake Company produces a single product. Last year, Blake's net operating income under absorption costing was 3,600, lower than the under variable costing. The company sold 10,000 units during the year, and its variable costs were $9 per unit, of which $1 was variable selling expense. If production cost was $11 per unit under absorption costing, then how many units did the company produce during the year? Is it letter A, 8,200 units? Is it letter B, 8,800 units? Is it letter C, 11,200 units? Or is it letter D, 11,800 units? So I'll be giving another 10 minutes, guys. Okay? So the answer here is letter B. So how did we compute for this figure? Okay, guys, in this problem, we are asked to get the units produced for the year. Okay, it will involve a lot of analysis in this problem. Okay, so in this case, no, it is noted that the net operating income under absorption costing was 3,600 lower than the variable costing. If that is the case, since we have a lower net income under absorption costing than your variable costing, what can we infer in this case? You have a lower manufacturing fixed overhead cost under variable costing will be outrightly expensed in the income statement. However, since we have more units that we sold, okay, so the fixed manufacturing overhead cost under absorption cost that is in the beginning inventory now expense under cost of goods sold. That is why we have a higher cost under absorption costing, making the net operating income under absorption costing lower than your variable costing. Okay, so how do we start with this? So we now have an idea. The units produced should be lower than your units sold. So probably it will be letter A and B. So how did we get your answer letter B? Okay, so we have here, okay, your variable cost per unit of $9 per unit. However, it includes the variable selling expense of $1. So let's put it in here. Okay, variable selling expense of $1. We need to deduct this one in order for us to get the $8 that is referring to the product cost excluding fixed manufacturing overhead. Okay? Since we have here your production cost per unit or product cost per unit of $11, we can assume the difference between the two of $3, okay, will be your what? Fixed manufacturing overhead cost per unit. And this will be very crucial for us to get the units that we produce. Since we have here that your net operating income under absorption costing is 3,600. So this will be our numerator. Okay. So in here, the difference in okay, net operating income of 3,600. Okay. We now divide it by the fixed manufacturing overhead cost of $3 per unit. Okay. And we will get the units relating to the difference. Of 1,200 units. Okay, please do remember that since we have a lower net operating income under absorption costing than the variable costing, so our assumption here that our units produced should be lower than your units sold. Since we have here units sold of 10,000, we will deduct the 1,200 pertaining to the units relating to the difference between the absorption and variable costing. Okay, so our answer here is 8,800. So here is your units produced. Okay, this is your unit difference. Okay. So our answer here is letter B. Okay? Next problem. Pungent Corporation manufactures and sells a spice rack. Shown below are the actual operating results for the first 2 years of operation. So we have here your unit spice racks produced for years 1 and 2, both 40,000. units sold of 37,000 for year 1 and 41,000 for year 2. Absorption costing net operating income 44,000 under year 1 and in year 2 it's 52,000. And we have here your variable costing net operating income of 38,000 under year 1 and question mark for year 2. Okay. Pungent cost structure and selling price were the same for both years. What is Pungent's variable costing net operating income for year 2? Is it letter A, 48,000? Is it letter B, 50,000? Is it letter C, 54,000? Or is it letter D, 56,000? Okay. Okay, our answer here is letter C. So how did you get letter C? So in this case, class, we are looking for the variable costing net operating income for year 2. So we need first to analyze in year 1. No, there will be some crucial information that will be helpful for year 2. So we need to get your what unit fixed manufacturing overhead cost. So how do we get that one? Please take note that we need to get the difference between the net operating income under absorption costing and variable costing, no, for year 1. So it's 44,000 minus 38,000. Okay. Why do we need to get the difference? Please remember that it is always that the difference between the two net income under absorption and variable costing really comes from the fixed manufacturing overhead cost. Okay, so in here, we need to get the difference. No? And then, in order for us to get the unit manufacturing, fixed manufacturing overhead cost, we need also to get the difference between the units produced and sold. So that is 40,000 minus 37,000. So the numerator here it's 6,000, then the denominator it's 3,000. So our unit fixed manufacturing overhead cost it's $2 per unit. Okay. So in year 2, we have a net income or net operating income of 52,000 under absorption costing, and we need to analyze the units produced and sold. So in this case, we have a lower units produced than units sold. So what can we infer in here? So if there is lower units produced, meaning to say the fixed manufacturing overhead cost relating to the units produced will be what? Lower. No, we have a lower fixed manufacturing overhead cost. If that is the case, okay, we can say here that your net operating income under variable costing will be what? Higher. Why? Please do remember that we have a difference here of 1,000 in terms of in the difference between the units produced and sold. So meaning to say we sold more than we produce. So meaning to say there would be some of the fixed manufacturing overhead cost that was in the inventory under absorption costing that was only recognized as an expense, making the net income under absorption costing what? Lower as compared to your net operating income under variable costing. Okay. So in here, we have your net operating income under absorption costing. How much? That is $52,000. Okay. And then we have your what? We add your fixed manufacturing overhead cost released from inventory under absorption costing. So we now add back the fixed manufacturing overhead cost of, how do we compute that? It is your difference in inventory of 1,000. Okay, so it is 1,000 multiplied by the fixed manufacturing overhead cost per unit of $2. Okay, so that is 2,000. So we only add this 2,000 from to 52,000. It will give us a value of 54,000. So this 54,000, it is your what? Net operating income under variable costing. So the answer here is letter C. Okay. Next problem. CFO Corporation manufactures a variety of products. Last year, the company's variable costing net operating income was 90,900. Your fixed manufacturing overhead cost released from inventory under absorption costing amounted to 21,900. What was the absorption costing net operating income last year? Is it letter A, 69,000? Is it letter B, 90,900? Is it letter C, 21,900? Or is it letter D, 112,800? So I'll give you another 10 minutes to solve this problem. Okay? So, the answer here is what? Letter A, 69,000. So, how did we compute for this amount? Okay, so we have here what we call your fixed manufacturing overhead cost released from inventory under absorption costing. If that is the wording, no, meaning to say, no, we recognize additional fixed manufacturing overhead costs from your inventory, making the cost of goods sold under absorption costing higher as compared to your variable cost under variable costing. No, making your net operating income under absorption costing less or lower than the net operating income under variable costing. So how do we solve this one? Okay, we have here your net operating income under what? variable costing of how much? 90,900. And then we deduct your fixed manufacturing overhead cost released from inventory under absorption costing of 21,900, no? So we deduct. And then it will give us a value of $69,000. So this is your net operating income under absorption costing. So the answer here is letter A. Okay? Okay, does it make sense? So you have a lower net operating income under absorption costing as compared to your net operating income under variable costing. Why? Because again, no, we have released the manufacturing overhead cost from the inventory under absorption costing. So the said cost is charged in the revenue, making your net operating income lower. Whereas with variable costing, it will not be affected by the release of the fixed manufacturing overhead costs from your inventory, because again, under variable costing, your fixed manufacturing overhead cost is outrightly expense, no, or it is expense immediately. It is not anymore inventoried. Okay, next problem, no. Fearsome Corporation manufactures a parachute. Shown below is the Fearsome's cost structure. So we have here your we have two columns. We have your variable cost per parachute and total fixed cost for the year. No, for your manufacturing cost, no, we have $160 as your variable cost, and selling administrative, that is variable cost, that is $10. And we have your fixed cost for manufacturing cost amounting to $342,000 and $171,000 for the selling and administrative expense, that is fixed cost. In its first year of operations, Fearsome produced and sold 4,000 parachutes. The parachutes sold for $310 each. If Fearsome would have sold only 3,800 parachutes in its first year, what total amount of cost would have been assigned to the 200 parachutes in finished goods inventory under variable costing method? Is it letter A, 28,000? Is it letter B, 32,000? Is it letter C, 34,000? Or is it letter D, 49,100? So I'll give you another 10 minutes to solve this problem. Okay? So guys, what is the answer in this problem? It's letter B. Okay, why? Okay, why 32,000? Okay. In this case, no, we use sensitivity analysis, and the first assumption here is that we have produced and sold 4,000 parachutes. So there is no difference in terms of net income. Okay, and of course, there will be no value for finished goods inventory since there is no inventory as there is no ending inventory. In this case, what if 3,800 only were sold? So there is a remaining 200. How much would have been assigned as your finished goods inventory relating to this remaining 200 parachutes? So how do we compute for that? No? So we have here your units in ending inventory. It's how many units? 200 units or parachutes. And then, how do we now get the value of your finished goods inventory under variable costing method? Since we are getting the finished goods inventory under variable costing, we only need the variable cost relating to manufacturing cost. So, it is here, 160 only. Okay, so it is our variable manufacturing cost of $160. And when we multiply the two, it will give us a value of $32,000. So this value pertains to your finished goods inventory under variable costing. So how about if the question is finished goods inventory under absorption costing? So we need to get also the fixed manufacturing cost. Okay, so in this case, no, we need to divide 342,000 by the units produced of 4,000. So whatever the value that we get in here, we will just add it in the variable manufacturing cost in order for us to get the total manufacturing cost under absorption costing, and we multiply it with the units in ending inventory. We will now get the value of your finished goods inventory under absorption costing. Okay, so guys, thank you for listening for today's sessions. If you have any question, no, please type in your questions, raise your hand, or you can unmute your mic and speak or just ask your questions. Okay, so guys, thank you. Okay.